Good morning, traders and investors. This morning, Monday, September 16th, you got two major drivers of the market. You've got the Fed, which is, of course, in charge of trillions of dollars and interest rates and an upcoming decision. And then you've got Apple, which is once again the largest company by market cap in the world, bigger than NVIDIA, bigger than Microsoft. But maybe not for long because we've got some negative, some bearish headlines for Apple this morning. We'll discuss that, weighing on big tech. We've got some analyst upgrades and downgrades. We've got to discuss the upcoming Fed decision on Wednesday, some volatility there as well. So little bit of a slower news day, but that doesn't mean we don't have a lot to talk about today on Pre-Market Prep. We've got Greg Weldon joining us at 8:35. We're going to talk some commodities, talk some oil, talk some macro with Greg as well. So excited for the show. Let's go ahead and get it started. Welcome to Benzinga's Pre-Market Prep.
This is a volatile puppy here.
It's all about execution styles and strategies.
All righty, pre-market prep. Let's go ahead and take a look at the overall market as we head into the day. S&P 500 trading down about barely 19 cents here, but the Q's getting a little, okay, we might be getting some weird prints here because it was different when I checked it a few seconds ago, but the Qs are trading lower. I mentioned some bearish Apple news helping break down big tech. Let's check in on Bitcoin. Haven't looked at Bitcoin here in a minute. Okay, back up to right around 60,000. You dipped to around 55,000 in Bitcoin. Now inching back toward that 60,000. We can look at the chart here. Got down to about 52, pop back up there a little bit. Let's check in on the Dow Industrial Average in the green this morning, as is the IWM. So you've got a little bit of a mixed bag this morning with the S&P and Qs in the red, while the Dow and IWM are in the green. Let's go ahead and welcome a man, Dennis, on the stream. Dennis, how are you doing this morning? How was the weekend?
Boating yesterday, amazing. Out on the island with some friends. The weather, unbelievable. 80 degrees in mid-September up here in Georgian Bay is unheard of. So just a beautiful day boating. Tired today. We won't talk sports with the Lions, so we'll leave that be. How was your weekend?
Well, it was good, but I'm going to have to talk some Lions.
You're going to have to talk the Lions.
Well, I wasn't actually at the game yesterday, but I was downtown with friends watching the game, at a bar right next to the stadium. So everyone is out and about. I mean, like the downtown Detroit now for the Lions games is insane. People are out at 10 a.m., 3 hours before the game, getting ready, getting all nice and liquored up before the game. And I mean, here's the thing is that, like, okay, it was a tough loss, and the Lions in some ways looked really good. It was mostly the red zone offense and defense, a couple penalties that put the Bucks, right at the 1 yard line. But in a lot of ways, the Lions actually, I thought, looked better yesterday than they did week one against the Rams. And Dennis, you're a big hockey fan, and it's in hockey and basketball and baseball. Okay, you lose a game. It's whatever. You have 82, games in the season, or in baseball's case, 160. Yes. In the football season, you have 17 games. So you don't really have a lot of opportunities to kind of let games slip away. With that said, I mean, the Lions went to the NFC Championship game last year, and they started the season 1-1. So I was with a lot of Lions fans yesterday that were freaking out about the loss, and it's like, find the middle ground of understanding, okay, it's not great that you lost this game in a 17-game season, but it's also not the end of the world. So it is what it is. I think the team has some things, to work on, which is good. Hopefully Amon-Ra St. Brown isn't too injured, and they should be fine. But overall, I mean, it was a good day of football. The New Orleans Saints, I don't know if we've got any Saints fans in the chat, but they look legit, absolutely crushed the Cowboys in Dallas. So that was probably your surprise of the day yesterday in the NFL. But let's transition from sports into the market. Let's just hop right into the biggest news of the day. I mentioned on the hop that Apple is once again, I didn't even realize how big of essentially of a lead Apple has gotten on. I mean, Apple got up to almost a $3.5 trillion market cap, while I believe Microsoft and NVIDIA are both below 3 now. Either way, or no, Microsoft is back above 3, but NVIDIA is below 3. So Apple reclaimed its title as the biggest company in the world by market cap. This morning, though, we're getting news that the pre-orders for iPhone 16 lower than expected demand. And you had different analysts coming from Jefferies, from B of A, commenting on this. So, this was one of the things that was driving Apple stock higher into this cycle, was people predicting that the new AI technology that is coming in these phones is going to help drive an iPhone super cycle, where everyone kind of, maybe a lot of people didn't get the iPhone 15 in anticipation of getting the iPhone 16. Either way, the iPhone 16 demand so far, phone's not even out yet, but so far is a little bit lower than expected. I don't really know if this is specific to maybe the product didn't excite enough people, or maybe it's a sign that the economy, that people are being a little bit more choosy where they spend their money. So maybe people are saying, you know what? Maybe I don't need the new iPhone. Mine's working fine. I can keep using this one for a few, for another year or so. Whereas in the past, if maybe the economy, if people felt like they were in a stronger economic position, would be willing to make that upgrade. So maybe a mix of both there, but I don't know, exactly which one we can attribute that to. Either way, the result here is Apple trading down $5.50, 2.5%, bringing some other names down with it. What do you think about this, Dennis?
And analysts commenting here by B of A with commentary saying ship dates slower than the prior year. Jefferies sees demand weak as well. Barclays reiterates they're underweight on Apple, citing weakening consumer demand, macro pressure, and competition here. So not only do we get these comments, from and it's analysts. It's is that overseas? Like, I don't really follow Kuo. I had it open, but they're the ones that came out over the weekend and said that they see the weaker demand here on iPhone 16. So any regard here, bottom line is the stock is having a really rough morning. If you're looking at why the S&P is down, you don't have to look any further than Apple. It is dragging down the Qs as well. And you know what happens when you get tech selling off? They have to buy something else. It's just the way this market works. So non-tech stocks are having a pretty good morning. The market never seems to just rotate out of stocks altogether. It rotates into tech or out of tech. And when they're going out of tech, they're going into the banks. The banks are trading higher. They're going into the consumer staples. The consumer staples are going higher. They're going into the small caps. The IWM is trading higher. So there's always that rotation here to be aware of. What is bad for one sector seems to always be good for another.
Yeah, so you're seeing the IWM in the green again this morning, which the IWM, I know if you pull up the chart real quick, had a very strong week last week. Of course, the day, actually on the daily, so you can see here on when was this? Wednesday, it dipped down to around 204, the IWM, and then popped back up to above or to right around 220. So on Friday, the IWM went up 2.5%, closed up $5, and is now again continuing to move higher. Do you think, Dennis, we've talked about the IWM and small caps, their tendency to lag, and they just haven't been that great of an investment, even when people have called for them to start outperforming. It's starting to look like the bottom could have been in for small caps, that if we can clear, this high that we got to in 2021, eventually that small caps finally might be in favor. I know we've said it before, and maybe the timing wasn't right, but now at this point, Fed getting ready to cut rates, which we'll talk about in a little bit. But small caps. Would you rather be buying the S&P right now or small caps?
I'm still, and I still have some IWM, but I'm obviously heavier tech, and I just think going forward, the story is still going to be tech. And we can say there's going to be an IWM catch-up trade. Tommy Lee's obviously called for it, saying 40% rally by the end of the year. They got a lot of work to do to get to that. It was a good couple days, a good few days. And you do have to consider that the environment that we're going into, a rate cut cycle, should be good for small cap stocks, because a lot of these companies are not in profitable positions. We've had Jim Tassoni coming on, obviously, and talking about how a lot of the companies that are in the IWM do not make money. So, lower rates definitely helps. And bring up that Fed tool here right now, AB, probably good timing for it, because we're talking about a 50 basis point cut this week. So it was 25 forever, but now the majority has gone to 50. So give us those updated numbers.
Yeah, so you can look here. I'll blow it up real quick on the screen so we can see, so everyone can read it, hopefully. But, a week ago on September 9th, it was a 30% chance that we would get a 50 basis point cut. a 70% chance we would get a 25 basis point cut. I think, that was kind of the consensus was, okay, you have, the labor market cooling, but not too much, inflation dropping. Let's just cut slowly. Let's go 25 basis points. Now, today, it's basically the exact opposite. You've got a 63% chance for a 50 basis point cut, a 37% chance for 25. So it's still not set in stone. I mean, it's, closer to 50-50 than it is 100% and 0. But now it looks like the market is leaning toward 50 basis points.
Yeah.
And I'll be dead honest with you, Dennis. I don't really know what happened between, last Friday or today or last Monday and today that has changed this much. So if anyone in the chat knows, I guess let us know, because again, like if you would have asked me, I would have said, okay, we're probably still leaning toward 25 basis points. I forget who we were talking about it with last week, but like this idea that it's bad to get 50 basis point cut because in the past that has come during
that was Jim. Jim was saying it. And the reason, if we look at the stats, is because whenever we've got a 50 basis point cut in the past, because we've been in a serious, markets have had serious issues where we were, in the financial crisis, COVID, it was always some type of crisis. So now just cutting 50 out of the blue, that doesn't happen very often. But we know they, obviously raised rates historically as fast as they ever have, sometimes going 75. So we're just going to take some of that back. So I don't know how much weight you can say, oh, if they're cutting 50, there must be problems. I don't think they see it that way. I think they see it that they really raised for, maybe, a long time, obviously, and faster than they ever have before. And now they're going to bring some of that back. I think they're going to do 50 as well. But the other thing to consider is the economy's not in recession. The economy has sustained higher rates. So why, just go crazy here, start lowering rates as fast as you raised them, and then let inflation creep back in? That's probably the commentary that's happening at the Fed. So it's still not certain if it's going to be 25 or 50. And it's still not certain even the market reaction. Like naturally you think, oh, if you see that 50, and you're going to see small caps rip if it's 50. But is that necessarily good for big tech? So it's interesting because big tech works in a higher rate environment as well. We've seen that over the last couple of years. So it's going to be really interesting to see what happens there. It's going to be 25 or it's going to be 50. We know, but we don't know. But we know they're cutting, but we don't know how much.
And let's bring it back to Apple real quick, and then we'll get into some of the names that are also moving off this Apple headline. Okay, so let's say this preliminary data is, correct or trending in the correct direction, and iPhone 16 sales end up being a little bit weaker than expected. I mean, on a scale from 1 to 10, Dennis, how big of a deal do you think that is for Apple?
That's a huge deal. I mean, iPhone is half of their sales. So every year, you think, okay, this upgrade cycle may be a little bit slower. And it's always been the case where they still kind of kick and butt. At a certain point in time, to your point, maybe the consumer is a little more stretched. Maybe they're not going to upgrade every cycle. I upgrade I have a 12. So I go every 4 to 5 years. I don't need the new camera. I don't need, and they're saying AI intelligence and Apple intelligence and all this other stuff on there, but I don't. If somebody came and said, you got to see my phone, I just got the 16, it can do so many different things. That's what really sparks upgrade cycles, is when your buddy comes over and you see the phone and you're like, holy crap, I got to get one of those. I'm going to go upgrade tomorrow. Well, if that's not happening, that's an issue. So weaker demand is going to, if you're already seeing it weak out of the gate, that means my buddy's not coming over, probably showing me his new iPhone 16, which isn't going to make me want to go buy one either. So lots of considerations here. The other consideration, which we have talked about on this show nonstop, is Apple's valuation is as high as it has been in basically 20 years. It has not traded at, and let's just go to our trusty Benzinga
It's
Pro.
It's a 29 forward PE, price to sales of 9, which the price to sales is quite expensive. I don't think the forward PE is that insane. I mean, obviously, if it was, closer to 20 rather than 30, it'd be, a little bit more reasonable. But I think if you look at other, some of the Mag 7 peers, whether we go to Amazon, that's at 31 forward PE. You go to Microsoft, that's at
Microsoft's expensive too. We've talked about that one.
32.5 PE. So I think it's kind of on par. You go to Netflix, kind of on par with a lot of these other big tech 31. I mean, they're all right around 30, but I mean, you could make the argument that these other companies actually have more growth right now than Apple, which going back to Apple, I mean, if I was going to try to argue the other side and try to say like, you know, and full disclosure, I am a Apple holder. It's probably one of my biggest holdings in my long-term portfolio. You know, I couldn't say this isn't a big deal about the iPhone 16, but what I guess what I could say is that like it would be a death sentence for a growth stock if a company comes out and says, okay, our main product now growth is slowing on that, right? If Nvidia comes out and says, oh, the growth is slowing on our Blackwell chips or something, I think you'd see that get hit, you know, 10+%. I don't really see Apple as a growth stock anymore. So,
and that's the issue. You just made my point. Why are we paying 30 times for a stock that isn't growing, a company that isn't growing? It doesn't make sense. You don't pay 30 times earnings when the company's not growing. So that's what I've argued for a while. I sold all my Apple. I had Apple in my long-term portfolio. It was one of my best stocks. I think I put it in there at about 2012, maybe 2013. My average cost base is $25. So you could go back and look, you know, at the charts and try to, you know, pick, you know, where, you know, I potentially bought this, but it was probably 2016, somewhere in there. I had it in my long-term portfolio for 7 years. I sold it last year. You guys know when I sold it, around $180. And that was because I was like, when I bought Apple in 2016, its PE was 14. It was under a market multiple. And they were saying, well, it's a consumer staple, you know, and you know, so eventually it should, if it's going to, you know, it should have a higher multiple. That was always the argument. The argument has changed, and things just don't happen overnight, and things just don't change overnight where, you know, sentiment turns and they realize the stock's overvalued. But what does happen sometimes overnight is you get headlines like we just got over the weekend where they see a little bit of slowing growth. That multiple cannot sustain any more slowing growth because they haven't had any growth. So you don't want to see the actual numbers. You can start talking about sales actually declining, like revenues not even not growing, but actually going down. That would be a major issue for Apple. Those are the risks. The obviously, you know, the bull thesis is Apple Intelligence is coming, next Vision Pro, next product's going to drive it. Apple's going to be a huge player in AI, and it's going to grow into this multiple. That's the bull thesis. I think Apple's a little bit of a prove me story at this point in time. We know Nvidia's proved me. That's why their multiples expanded, and that's why obviously the stock price went up so much. But I think Apple's in a little bit of a prove me spot, and getting headlines over the weekend, multiple analyst commentaries saying iPhone 16 demand is weak, doesn't make me want to go out and buy the dip this morning.
I agree. I mean, I'm not going out and buying more Apple on this. And to your point, where the valuation extended, maybe this negative headlines of Apple keeps moving in the wrong direction for bulls, that eventually it does get down to a more realistic valuation and closer to a 25 or 20 forward PE that entices some new investors to come in because it's a good valuation. I just think, I mean, my thesis on Apple has always been like, you know, they tend to do products pretty well and know what the consumer wants. And over time, you know, if you've bought dips on Apple, it's always been a buying opportunity. I mean, right now it might be the time where other companies do start to catch up with it. I mean, we know in the US specifically, it has such a stronghold in the smartphone market, but getting some, you know, signs overseas that in China, you have the Huawei phone, which people are you know, the pre-orders have exceeded there. So maybe people are catching up to Apple a little bit. But moving on to some names that are moving on this Apple news in the chip space, you have Micron Technology, which had a great day on Friday, closing up more than 4% after getting beat up. You know, we look at the daily chart here, zoom in. I'll go down to a 2-hour chart here so we can see kind of the price action last week. It popped all the way up to above $90. Now trading lower, I think, you know, basically just solely on this Apple news, because Micron does a lot of chips for smartphones. So to see that, you know, Apple, and you go to like a lot of these chips.
We've got a chip wreck here off of Apple. You're absolutely correct. Applied Materials trading down $2.50. Qualcomm, direct supplier to Apple, down $2.23. You go to Broadcom, it's down $2.19. Then they're dragging Nvidia and AMD down with it, even though you know, I don't think of them as Apple suppliers here, but it's just they're dragging the chips down with Apple.
Yeah, so, you know,
And they're dragging some of the other tech stocks down with Apple too. Like tech is now, you're looking at the Qs, it's down 2 points here. It is significant. Back to the Micron before you leave that one. It was the old undercut and rally trick though, where we talked about those lows at $84, and they did take out those lows, 84.87, 84.91, the double bottom, but then it took it out 84.12, and then it just ripped $7 straight straight up. That's the Gil Morales undercut and rally, and also the Red Dog reversal, multiple names for similar type of move. Those moves actually do usually bode well, but now you get fundamental news always trumps technicals. So that is hitting Micron. I mean, Micron is, and again, because it's such a cyclical business, it's very difficult to project earnings. Some analysts have Micron making $11 next year. Some analysts have it that high. So you're talking about a stock trading a P of 7 if they hit those numbers. But then, other analysts don't have it there. And if the cycle, changes, DRAM pricing changes, that can change the estimates for Micron too. I am long Micron in the long-term portfolio. I do think there's value here. But at the same time, I know this business is cyclical. And sometimes, when you're coming in here, sometimes you can get caught on the wrong part of the cycle and it can really move down. But I mean, the stock was $157 3 months ago. It's basically almost been cut in half. I mean, not quite, but we're down like over 40%. Significant discount. There's a lot of tech stocks that have had a significant discount from those highs. It hasn't been just, all rainbows and, all kind of great stuff and teddy bears and everything. It's been kind of tough in tech. It's been kind of tough in tech for a couple of months. Despite the big rally that we had last week, overall, we're kind of still in a trading range. And that even applies back to the IWM as well, because we're in a trading range there too. I mean, really, we can say, oh, what a great week here. This is different. We're going to go. But I mean, really, we've been in the same trading range we've been in for the last few months. 200s giving you support, 225, 220s, you're getting sellers up there. So as we get back towards 220 being up at 217.82 this morning, it makes me want to sell it a little bit more than buy it. I think respect the trading range until we actually do start getting all-time highs. And AB, you're on mute. You had to do it for Joel. You had to do the mute trick. We're just, that's obviously for Joel. And that's the other concern this week, is that Joel's not around here right now.
And we know what happens.
Whenever Joel takes a few days off, the markets tank. So I think, honestly, the Apple iPhone or the iPhone 16 would have more sales, Joel, when taking the day off. I'm blaming Joel for that. That's what we can agree on. The market always goes down when Joel takes a couple days off.
And you look at Micron's chart here, and I mean, you're back below these levels that we saw in April 2021. If you would have told me that, like, especially a chip stock like Micron would be back at its 2021 levels, I would expect that big tech overall was in this like big downtrend, and not that the Qs were basically at or right at, near all-time highs. So I guess it's interesting once you dive in and see the individual names, which ones have really been driving, this surge higher, because again, a lot of these stocks are cut down. And I mean, to your point, basically cut in half. I mean, yeah, $160 Micron got up to, or just about, back in June. That was 2 months ago. That was 2 months ago. And now we're looking at 2.5 months ago. And now we're looking at it down below $90. So, if you're big overweight in Micron, I mean, what was the, man, there was one big tech stock that was making new all-time highs last week that was just kept pushing higher. It wasn't Broadcom. Maybe it wasn't a chip stock, but it was, or maybe it was. No.
Tech stock? There's been stocks making new all-time highs, and there's been a lot of stocks non-tech making new all-time highs there too. So this has been, the last little while, it has been a rally really driven by non-tech. So,
I was thinking of Oracle. Oracle, I mean, it was just,
oh my gosh, I got run over. I told you about that Oracle trade. I got run over in it, and basically, and then it came right back in. And I was like scratching my head on, the headline, and I'm like, 2020, they're talking about like 2027, 2030. I'm like, who the hell has a crystal ball to go out 6 years? And you know what? The market did end up calling the bluff on this, because the stock was trading up like $13 at one point in time. I won't see it on the chart, but after hours, it just went crazy. Actually, it was up like $11, $12 even intraday. It was just ridiculous. I mean, they had earnings last week. They gave guidance, and then they decided to come out at some conference and start talking about earnings 6 years from now. Well, nobody knows anything 6 years from now. It was ridiculous. But the algos just say, oh, yeah, they're raising guidance, we better buy it. And then real people coming in and actual institutional money managers saying, How the hell does Oracle know what they're going to do in 6 years? It's up $12 because they think it's going to be going up in 6 years. You know, that revenue is going to be here. Nobody knows where they're going to be in 6 years, and they sold that rally. I wish I would have held the short. I did not. I got beat up on it, but it's one of those trades where you just can't let stocks just get away from you. So you got to cut the loss, especially when stocks are making new all-time highs. But the reversal actually, you know, isn't surprising to me at this point, even though I didn't, even though I didn't make money on the reversal. Not surprising that money managers would come in and hit something when they're talking about earning 6 years from now.
All right, let's get into some other individual.
TX saying, just before you go, and I want to make this point too, he's saying it looks like a blow off top in Oracle now. I think so too. I think actually backing and filling now. Now you've got a level in on 173. If you see a little bit, yeah, I think somebody was upgrading today. I think it was Scotiabank or somebody like that. I mean, way late to the party here. Like, come on. You know, you're here, Oracle upgraded. Sorry, it was Melius upgrading, but Oracle also Deutsche Bank raising the price targets. Analysts were all chasing the price on that commentary. Remember a couple days ago there where you had like 6 price target raises, AB. That's more signs usually when the analysts are all just chasing. That's usually the sign say, hey, let's ring the register on this one. It's a big move for Oracle. And where is the PE on Oracle now? I want to know that too, because when I was long Oracle back in the day, the PE was like 18, 19. It's moved up too.
25.5, so not
it's
crazy.
Getting high.
It's high, yeah. High, but not crazy for Oracle. And yeah, we'll keep watching next. And
pretty high for Oracle.
It'll be a volatile stock as it, you know, I mean, it reached that new all-time high, sold off. I mean, you look at it, it was a 175 all the way down to 160. So a little significant hit there for anyone just trying to chase Oracle, especially like you mentioned after those analysts coming in all raising. But all right, let's move on to some other individual headlines we have this morning, some analyst upgrades and downgrades. We'll start with Zillow Group. Zillow Group trading higher after Wedbush upgraded the stock from neutral to outperform, raised the price target from $50 to $80. So that's a significant price target raise from 50 to 80 there. You're seeing Zillow Group, which closed up more than 5% on Friday, trading up another 3% this morning. So Zillow Group starting to heat up. I don't know, exactly what was talked about in this note, if it's fundamental. I mean, but you have to assume that with interest rates set to come down, that brings mortgage rates lower. That might drive some more home buying activity. I mean, so I think a lot of people in the last year or so that have been on the fence about buying a house or been waiting have been, saying like, oh, let's just go ahead and wait till rates come down a little bit and then we'll make our stab at it. So, again, rates set to come down here could put some action in the home buying market. Zillow now, I mean, the chart looks...
Where's the PE on Zillow? You got it right there.
PE on Zillow is for PE
again cyclical too. It's a little bit cyclical.
36.7.
A little bit cyclical. You're coming into, if you're going into a rate cut cycle, this is a stock that would be on my list for sure. So, I mean, down 50 is going to be huge for Zillow. So they get the 50. I'd expect a big pop in a stock like Zillow. It's breaking out. We've been in this long bear market for Zillow. And I mean, you look last 2 years, like, what are you talking about, Dennis? Look out to 2021. This stock was $212. So now you could just say the last 2 years, it's been, basically, real estate has not been moving. We know that it's been kind of, but if we start seeing rates go down, maybe we do start seeing real estate start moving here again. And maybe this is actually good for Zillow. So this is the kind of stock I actually would be buying on dips. I'm even writing it down. I don't own any, but I'm looking at this one.
Yeah, and I guess just keeping the trend going with other, stocks that could benefit from interest rate cuts. Let's go to Upstart real quick, which is actually getting hammered this morning on an analyst downgrade.
I think it's an offering.
Offering, you're right. Sorry.
Convertible.
Yep. Upstart.
This is the problem. Just go on. Give us the news, and I'll give my analysis. Go.
Upstart Holdings intends to offer $300 million of convertible senior notes due 2029 in private offering. So Upstart, which has been on kind of a run the past few weeks, is now trading down almost 9% pre-market this morning. I've got the daily chart pulled up. I'll pull up the pre-market chart as well so we can look at that action. But Upstart got all the way up to around $46 a few weeks ago at the end of August. Now traded down to around 30, pop back up, now back down to about $35 flat. Let's go to the 5-minute chart here so we can see the price action this morning. Just kind of a straight elevator ride down for Upstart here this morning. Go ahead, Dennis.
lower rates do help this stock as well. But this is the problem when you're going and buying stocks after like companies that have really been beat up. And, obviously Upstart has been struggling as well. When you get these rallies, they often do offerings because they're like, oh, the stock price is elevated. Now is the time to do an offering. And just like that, boom, boom, Upstart gives back basically most of its, rally from last week. And it was a big rally. We were down at 32. So it's not giving it all back, but giving a good chunk of it back here. So am I a buyer of this dip on Upstart? I'd wait to see what the pricing is. Maybe we already know the pricing, but it's just not my kind of stock. I think this business, I'm just not a huge fan.
Yeah, I mean, the one thing I'll say, I guess, is that if you are a growth stock and you like the company long term, and that raising money to put more money back into its business maybe isn't necessarily the worst thing in the world. Obviously, if you're a holder, you don't like to see the offerings, but if you believe in the management and the company, and you think that, okay, this $300 million is going to go to growing the business and operations and all this stuff, then it might be the right strategic move long term, but in the short term, you see the hit that it takes on the stock. So the reason why we're saying, interest rates coming down is good for Upstart. Upstart helps, finance personal loans for people. So it's basically the technology platform behind, you apply for a loan on Upstart. I think they're using a lot of AI technology to do it too. They match you with a loan provider, so a bank or something, and it gives you your best loan offer with, and so when interest rates move lower, it makes getting that loan less expensive. So it increases demand for personal loans as interest rates drop. And then also, I mean, if the macro backdrop is that people are tighter, people have credit card debt or whatever they need to consolidate, then I think there's a chance you do see a significant increase in demand for Upstart services going forward, especially with this, with the rates intended to drop. So as far as the small caps go, when you look at the bucket of stocks in the IWM, I believe Upstart is one that actually has a decent balance sheet, or at least in terms of is like bringing in a decent amount of revenue. So if I was looking at individual small cap names to take a stab at, Upstart is definitely on my list. Now,
I'd rather have SoFi.
Well, I was just going to say, I would.
If I was picking one, I'd rather go with SoFi over Upstart.
Well, I was just going to say, I wouldn't be chasing Upstart right here because, this was a $20 stock a few weeks ago, and then it doubled to 40. So it's like, I don't like to chase these stocks once they've already gone up 100%, but just like overall, Upstart is still a beaten down name. So we can look at SoFi as well. But yeah,
SoFi's been in consolidation station here for 2 years.
Yeah, it hasn't gone anywhere.
If we do go into an environment where we're going to actually start lowering rates here, there's an argument that SoFi could be a double-digit stock again. So I actually don't mind the SoFi here, and I would be buying dips on SoFi. I kind of like that one.
Well, I don't think it's a question at this point if we are lowering rates. I think it's certain at this point. It's just a question if it's going to be 50 or 25, and then how long the Fed continues.
Yeah. That's what it is. How long do we continue to stay on that rate cutting path? Are we getting 2 more cuts this year? Or are we looking and saying we're doing 50 and we're going to just then reanalyze? What's the commentary on the 50? All that is going to come into play as well. Do they stay dovish, after the 50 and saying, yep, we're doing 50 and we're looking at another 50 next month? Do they talk like that, or do they talk, a little bit tougher love where we're doing the 50 and then we're going to reanalyze, and the market probably wouldn't like that. So it's not only the 25 versus the 50. The headline number will move it because that's just what the algos do, but it's going to be on his commentary in the press conference afterwards. We know that the press conference can really move. So sometimes you get a crazy fake out. And I honestly believe, if you get the 50, which we probably will, I think, that you're going to see a big pop in the IWM. You're going to see a big initial spike. But then it's going to be look to what he says. And if he comes off any hint of like, well, we're going to, just maybe pause here at this for a bit, the market would then just get slaughtered on that commentary. So, his commentary may actually be more important than 25 versus 50.
And what we know about the Fed is that, especially this Fed, because they've tried to learn from mistakes of past Feds where they had stop and go policy, where they raised and cut and raised and cut, kind of willy-nilly back and forth, that once they start a new cycle, whether it's a cutting cycle or a hiking cycle, they're like committed to that. I think it's basically every time the Fed has cut rates has been, there have been more cuts to follow. So it's like, I don't think this is necessarily, I don't think anyone expects it to really just be a one and done. With that said, I mean, we don't know how far the Fed's going to go. I think a lot of economists we've talked to, including Blue Putnam, think that, about 1% higher than what the running inflation rate is a good range for the Fed to be at, which right now, would be around, say like 4% interest rates. If you say that the running inflation rate is 3%, so that gives us about 125 basis points to go. So it'd be like 250 cuts and a 25 maybe, or something like that. So we'll see what happens. I think, obviously the Fed is going to be data dependent. So if they cut 50 basis points and all of a sudden the labor market's going crazy and it looks like inflation's coming back, then maybe they pause for a few months. So we don't know. We don't have a crystal ball, but we, of course, will be analyzing that data as we get it. All right, Dennis,
and I think we're choppy ahead of it.
Yeah,
I was going to say, I think we're choppy ahead of it too, but let's bring Greg into this conversation. Greg Weldon in the background here. I'm sure he's got some commentary here on interest rates as well. So let's go grab him.
Yeah, let's go ahead and bring on Greg Weldon from WeldonOnline. Of course, we know he's a commodities wizard. He's got some good macro takes and analysis as well. So without further ado, let's welcome Greg on the show. All right, Mr. Greg Weldon, welcome back. How are you doing this morning?
What's up, guys? How you doing?
We are good. You have a good weekend, Greg?
Great weekend. Yeah, absolutely. 100%. South Florida, baby. Living the dream.
Can't beat South Florida. So let's hop right into it. Obviously, we were just talking about the Fed's decision coming up. What's your kind of, I guess, like macro overall outlook right now on what's going on? Do you think the Fed should be cutting right now? How much do you think they should be cutting? How far do you think they should go?
I just say what Aaron said before I came on. That's my answer right there. No, it really is what you said. It's about launching a campaign, and it's a campaign to get policy to neutral, which you nailed it. I mean, you're talking about R-Star. You're talking about, the 311 pages of white paper that the Fed put out in 2018 that defined all of this going forward. How much harder it would be when you saw the turn away from zero interest rates and perpetually low inflation towards a higher highs and higher lows type of trend in inflation. Why? Because you have so much debt. So you have to reflate out of it, because the debt deflation would be the worst case scenario. So in that case, we kind of have to backtrack, because a lot of people are kind of caught in this position of, the economy's been a lot stronger than the Fed thought. And maybe the Fed, doesn't have to ease. And this has kind of been changed in the last couple of months with data, particularly from the labor market, that's been atrocious. Part-time jobs way up, full-time jobs way down, people working because of slack available work, working part-time, the multiple job holders off the charts. I mean, there's stress among consumers, and that's going to get worse. Why? Because the Fed only got restrictive a year ago, 14, 15 months ago. Why? Because in 2022, when they started raising rates, they were so far behind the curve, it wasn't even funny. You were talking about 9% inflation against less than 1% Fed funds rate, negative 800 basis points real rate. It took them 12 months to get to the point where inflation fell enough and they raised rates enough to get restrictive, sufficiently restrictive, which is what they said. Then as inflation kept falling, all of a sudden you're punitively restrictive over the last couple of months. The data is horrifying. It really is, from the ISM to the Fed regional surveys. Let alone the Twin Tower deficits are back. Holy mackerel. The budget deficit for August was insane. They spent more than twice of what they took in. You had one of the largest trade deficits in our history just published as well, back-to-back data points. So the question then becomes, okay, we need to get to neutral at the very least, because the economy needs it. And the question for the Fed has been a struggle, because will they be seen as acquiescing to higher general rates of inflation if they move to protect the economy here? But before you even get there, you got to get to neutral. And neutral is 150 basis points of rate cuts. So I think they have to move 50. I don't know that they will. I think it's a 50-50 shot whether they do 25 or 50. But they need to move 50, like you just said, Aaron, right on. You hit it right on the head. 50-50, 25, 50-50, 50. That seems extreme. But they need to get to neutral, because they need neutral now, not at the end of next year when it's priced into the Fed funds futures. And when you look at the time lag, which is based off this May, June, when the data really started to deteriorate because you had the 12-month lag from when policy got restrictive, that gives us months more of weakening economic data. The Fed's behind the curve. It's going to get worse. And my fear here would be that the stock market has an economic reality check at some point here.
Well, why is the stocks, if the consumer is showing weakness, like you say, why is the stock market as strong as it is? And I mean, the rally last week was nothing short of incredible, really, considering the previous, couple of weeks on the August 5th, debacle that we had. Where we are now from where we were at August 5th it's been an incredible comeback here. Is this all just on the hopes of the rate cuts, and that's why the stock market's perking up here?
Possibly. I think it's a bigger picture than that, because you say, well, the consumer's so strong. Consumer's not strong. Retail sales have been flat at best relative to the price increases. You have months, and we talked about this the last time I was on the show, where, the 1 month you had $27 billion in price increases across the board and all the things that people bought, and a $25 billion increase in retail sales. It was all prices. So retail sales are flat to down on a real basis. The consumer is struggling mightily. You talk about, they just borrowed $25 billion, one of the biggest months ever outside the pandemic in single months, right? And at the highest cost ever to do so. So high that the Fed, in their consumer credit report, has stopped reporting the average interest rate on credit cards. Out of the blue for the last 2 months, you don't have any data, not available, right? So in that context, you say, well, that shows the consumer's strong, right? No, not at all. Why? Savings are depleted. You went from 5.71 trillion in savings to 598 billion in the last report. That's the lowest outside of right around the pandemic since 2013. So savings is gone. You have no real wage gains, so you're not there. You have consumers that are borrowing money and working multiple jobs out of economic need just to pay the bills. And if you see that in the stock market, why? Because the consumer ETFs have gotten slaughtered, not only nominally, but more importantly, against the S&P 500. So this has been a stock market rally that is because it benefits companies. AI is going to be a margin improvement dynamic for sure. I would say it's an economic destroyer in terms of jobs. It's not going to be the internet where you create as many as you destroy. No way. So,
let's talk about that and go. And
Yeah.
I've actually opened that can of worms here too. And we can keep saying, AI is going to make life so much better for everyone, but it's not going to make life better. And I had this conversation with my brother-in-law over the weekend. Just unskilled labor. These jobs could cease to exist. So, I mean, if you're not educated and you're just going in like these, and even the minimum wage jobs, I mean, we see it already at McDonald's with the automated tellers, but I mean, it's going to go to an extreme where corporate business wants to make money. If they can make more money by having less labor, they will do it. So what are these people going to do if actually AI comes in and starts taking all these jobs? Some people are saying, oh, but there'll be, engineering and everything behind it. I don't think so. I think unskilled labor could actually suffer from this move.
Yeah. And what's interesting, 2 points that are important to make here, I think, for your audience is, number one, when you look at the latest jobs report, over 500,000 jobs created for the people with high school diploma or less educational attainment, a decline of 171,000 in jobs with people that had some college or some level of degrees. Then you look at the breakdown in the jobs created in the latest month, 1/3 were leisure and hospitality, the second lowest industry in terms of wages. So already you have the wage dynamic being skewed. Can you imagine all those people, like you said, without jobs already in New York? The latest thing, and I was talking to my son about this over the weekend. He was going crazy. It's like, it's robotic masseuses. Like every hotel room now in the high end has a robotic massage machine. Masseuses will be out of work there too. So that's just a kind of a front edge. But let me pose something to you. You can talk to your brother-in-law and have this conversation. It's great cocktail party fodder, right? Is to say, if AI is as good as it's supposed to be, which means it's self-learning. AI has no emotion, even though they have just created robots that will show emotion based on the words you say to it, right? But it's certainly not having emotions. It's unemotional. But as it learns more and more, and how quickly it learns, the first thing it should understand is our whole system of credit is flawed and has an end game that doesn't end well. And if it's as smart as people want to make it out to be, one of the first things it'll do is crash the system and start from scratch. So who's thought about that? Who's talking about that? Nobody. But those are the kind of things that are in the unknown that we're looking at. But in terms of the labor market, in terms of where the Fed is, the Fed needs to act. And frankly, when you talk about the budget deficit, the trade deficit, all the things we're talking about, the narrowness of the rally in stocks. And by the way, I would say last week, this was big money came in just when the market was about to crack wide open technically, and they put in huge bids for all the tech stocks. And to me, this was a campaign to show support for what was a Harris, debate win. And let's create the narrative that Harris is good for stocks. Don't mind the animal and the 800-pound gorilla over there, the unrealized capital gains tax. Harris is good for stocks. See, stocks rallied after she won the debate. So I think this was an organized campaign to save the market. It was technically about to break, but intervention never works for very long. So I think the stock market does have some day of reckoning coming. But in terms of it's really more about AI. Also, in the context of how it's driven stocks, we need products to sell to the consumers. You're a step or two away from that too. So I think they're, like you have been saying, some of these top level chip makers and the tech stocks look fatigued, overcooked, stretched, and everyone that wants to own them owns them. I could see the dollar is the key to all this. And when we're talking about all these debts and deficits too, this is negative for the dollar. The BRICS unit we haven't talked about, big time movement on this, negative for the dollar. And in that case, I could see a rotation out of some of the tech stocks into precious metals, something we haven't seen in forever in the passive investment crowd. So a stock like Newmont is coming off its cheapest level ever against the S&P 500. So I watch things like that too for tells as to the overall health of the stock market and confidence in general.
So would you still be buying gold at this point in time?
Well, I mean, I'm long. I think the GDXJ, which is the junior gold miners, are breaking out. Literally, they'll break out today. You had the GDX, the gold miner, the majors broke out yesterday. You're looking at rotation in terms of the ratio spreads, where the GDXJ is appreciating against the majors and against the price of gold, which is a huge tell for this sector. I'm not a gold bug by any stretch of imagination. I'll be long or short anything at any time. But right now, I mean, the setup, particularly in the dollar, which is on the verge of a major technical breakdown off of a multi-year ABC 50% correction that started at the 2008 low. That was a correction in the dollar bear market from 1982 to 2008. And why 1982? Because that's when Volcker lifted rates to ridiculous levels to kill inflation and kill the economy at the same time. You're in that zone right now. Watch the dollar.
Greg, let's talk some oil real quick, because there's been some concerns recently, about demand in China, obviously, some volatility, uncertainty in the Middle East, whatever you want to call it. Oil prices have dropped. You have filled up gas over the weekend for less than $3 a gallon, which felt like for the first time in over a year. Do you see the drop in oil as kind of a negative sign potentially for the overall global economy? Or do you think that's specific just to oil, that there's been some question marks about the demand, which is driving price lower there?
Well, you can kind of see that you had the breakdown in like industrial metals before this too. So you might suggest that the move in crude here is a macro, bigger picture sign of weakening demand globally. And I think it is. When you look at China, the numbers have been dreadful in China, particularly on the import side. And what makes that interesting is the exports are kicking butt, but the imports have rolled over. They're not keeping pace. This is why you have huge trade surpluses there. So, yeah, I do believe it's a sign of some weakness in demand, that kind of supply has been kind of artificially held down to some degree. Now the U.S. is producing crude. I would also say the timing of all this, very convenient for a certain party that wants to maintain power here in the U.S. politically. But, and having released so much of the SPR, about 40% of it, held prices down to 80 when it might have been $100 already. But to answer your question, I do think it is a warning sign. I think that is one of the kind of risks that applies to the stock market too, where it's a warning sign. There's an economic reality check out there because the global economy is not strong right now. There's no engine of global growth. You had this move in AI that provided that for a while. That's mature for its phase of this cycle on its own merits. So I think that bodes ill all over. And when you look at some of the global data, it's really interesting. The other thing I throw in, by the way, because I think currencies are so important here, is to look at the currencies that are really strengthening against the dollar, because they're currencies that are linked to resource trade with Russia and China. Polish zloty, Hungarian forint, for example, in Europe. You talk about the Indonesian rupiah and the Thai baht in Asia. You're talking about the BRICS currency unit. You have Turkey, a NATO EU member now, wants to join the BRICS unit. And I'll tell you, I have not pushed this kind of I've always believed the dollar is living on borrowed time. But this thing has come together so fast with such definition that appeals to so many people. It's actually viable, credible, and workable, and it's coming fast. And the dollar is already kind of breaking down on this kind of economic thing, the reduction of the U.S. interest rate premium, for example. That could really pose a problem for the dollar. I could see the dollar down 10 to 15% over the next year or so. Now, at some point, that becomes a bullish factor for the U.S. stock market. But declining currencies are bullish for Argentina, Turkey, Pakistan, Angola. It doesn't necessarily mean the standard of living or the economy is that strong.
So what would be your, like, I mean, I'm younger, so I'm pretty invested in the market, okay with a 20% correction in the S&P 500. I mean, what would be like what would you do as an investor if, we get this reckoning in the stock market, if the global economy, starts to look weaker? Are you just buying gold? Like what's your move in that situation? Going all cash?
Well, I'm a CTA, registered Series 3. We do manage outside money for, wealthy individuals, accredited investors only. And I believe this so wholeheartedly. I've been a futures guy my entire career, worked up my way through the hedge funds, through the Lehman Brothers, through the institutional side, and from the floor, right? So I've seen it all. And I've always kind of envisioned you're going to get to the point where you are in so much debt where you do have to use the dollar to kind of reflate out of it. And in that scenario, stocks will go up, and that's great. But being passively invested is going to leave you behind the curve in terms of keeping pace with the debasement in the purchasing power of your money, income, and wealth. We could look at, for example, the gold adjusted value of the dollar index right now just broke below 4 cents on the dollar relative to the 1974 dollar. It's at a historical low right now. When you go forward, you see all these countries that devalue their currency to try and prop up the economies. They have high inflation, they have high interest rates, and the stock market skyrockets, but it doesn't keep pace. So what we're doing is you got to be in currencies, you got to be in bonds, you got to be long and short, although I believe one of our products is the portfolio playbook. It's a U.S. stock-based thing, and we try and recreate the hedge fund, which I used to work in the hedge fund industry, /CTA approach using ETFs. So for right now, example, we're long the mortgage bond ETF, the MBB. We're long the real estate sector, XLRE. We knew a second the mortgage rates started to fall, you'd see action in those two ETFs, and they've been stellar. We also own the SHY, which is the Treasury. We also own, the gold and silver miners, and we owned a variety of currency ETFs that will perform as the dollar goes down. So I think you need to be diversified in all these things, maybe a little more active too. It's not a buy and hold mentality going forward, because that'll, you won't keep pace. So this is why, we've kind of crafted the research business that we have in addition to money management to serve the people that want to and understand the risks here to the dollar and what could happen here, to better protect themselves in terms of, maintaining some of the purchasing power of your money.
All right, well, there you have it. Greg Weldon, again, from WeldonOnline. You can follow him on Twitter at Weldon Live as well. Greg, always a pleasure to have you on Pre-Market Prep. Thanks for joining us on this Monday. Any final words for us? Any final words? I mean, Aaron Judge, go Yankees. Who's a Yankees fan? There you go. You guys are in Detroit, right? Are you got Tigers fans or what's up? Tigers have been heating up. They actually have a shot now of making the playoffs. Although I don't know what happened. They played the Orioles yesterday. I don't know what happened in that one, because they won. They're kind of in a mode now where they need to win almost every single game to clinch the playoffs. But if they sneak in as a wild card team, then they'd be one of the hottest teams in the AL. So that could get interesting here. I'm a St. Louis Cardinals fan, and we're officially toast on the season. So that's if the Yankees played Detroit by any stretch of imagination, then maybe there's a road trip involved. All right, there we go, Greg. All right, man. Well, again, enjoy the rest of your Monday. Thanks for hopping on Pre-Market Prep with us this morning. We'll dial your line soon. Take care. Thank you. All right, guys, we've got a few minutes of the show left. Dennis, I'm just catching up on seeing my list, seeing if we missed anything. We haven't talked about, there's a headline in the biotech space. Wow, this gave up a lot of its gains too. Exact Science Corporation. I'll go down to the 2-minute chart here, which it looks a little wonky, but you can see that it got up to $73, now down to $67. This was trading higher after the company announced data for its blood-based colorectal cancer screening test. So originally when I got in this morning, the stock was up like 10% and looked like your biggest gainer on the day. And then now it's only up, 3.3%. So definitely gave up a lot of those gains there. I don't follow the biotech space that closely, but the biotech space is probably one of the sectors where you're most prone to these news headlines that move the stocks, and that's what you're seeing this morning in Exact Sciences.
I mean, more the same, where we are seeing rips get sold. And I mean, we're still in this environment where, yes, buy the dip works, but sell the rip has been working fairly well. And that's what is indicative of a trading range, is where it's not, there's no follow through. And we're seeing this again and again on so many stocks where they get a big pop one day and then there's no follow through the next day, and then they start to leak and then they go back down, or we get a dip and there's no follow through that direction either. We're still just kind of sideways. It's sideways for the win here. And, you know, and people want me to talk on Greg. I mean, we've talked, you know, like this as well. I mean, everything Greg says makes perfect sense. It's just the market has ignored it. And I don't know when the market starts paying attention to it. Like, I completely agree with everything that Greg just said, you know, from where we stand, from, you know, obviously the consumer, you know, on the lower end has been hurting for a long time. So it's just that the market has pretty much ignored it. So it's hard to say that this time it's different, that all of a sudden, you know, everybody's going to come in and, you know, we've got, you know, an imminent issue. And if rates do actually start going down, does it help to solve some of the issues that Greg was talking about? That's, you know, possible as well. But when he's talking about owning real estate right now, owning, obviously, you know, and looking at others, real estate's been unbelievable. And that just moves directly with the TLT. You don't have to look further than that. So, you know, TLT has had a huge rally from 90 to 100. Real estate coinciding almost perfectly with it. And we know they're always linked, TLT, XLRE. So if you want to know what, you know, relationships are there, you see the TLT ripping, it usually is good for the XLRE, because that means rates are going lower and that helps real estate. But lots to chew on there. I mean, there was so much. Greg gave us so much information. We could comment for an hour on everything. You know, it was a fantastic interview, and everything, again, that he was saying makes perfect sense from, you know, a theoretical perspective. It's just a matter of, when does the stock market start listening?
I mean, you make it sound so easy, Dennis. Buy the dips, sell the rips. That's it. That's all we
That's what
do.
we're in. And we've been in that market for a long time. We've been in the buy the dip market before, and we've been in the sell the rip market before. But for the last 3-4 months, we've been in both. It has been a contrarian dream, really, where even intraday reversals. Think about the intraday reversals we've been getting. You know, to that S&P being down 1.5%, then closing up 1.5%. I mean, if you're a momentum trader, it's been a lot of trades have just petered out. They just don't have the follow through there. So you have to, like, basically all trading is, and, you know, again, I'm not an economist, so I can't comment to everything that Greg was talking about. My job is to analyze, you know, the tape and analyze the trade and analyze what's working recently. And as a trader with my trading hat on here, I'm just thinking, you know, there's a lot of, you know, there's a real battle here between the Bulls and the Bears, you know, that come in here, and Greg making some fantastic points. So, you know, I sit here and think, maybe this battle just continues, and maybe we don't, you know, have to go straight up or straight down. Maybe we just continue to chop around for the rest of the year. Possible.
I don't, you know, and I agree with a lot of what Greg was talking about as well. The one thing, and I've seen a lot of people talking about online, I think Elon was tweeting about it too, was like this idea that the dollar is trending towards zero, and people will say, like, this is the least value the dollar's ever held. But it's like, over time, that's always been the case. You know, in 1990, the dollar was less valuable than it was in 1970. And like, over time, that's always, you know,
it's inflation.
It's inflation. Yeah. And a candy bar when my grandparents were kids were 5 cents, and now it's $2. And it's like, that's how the money works. And any sound economist would tell you, you do want inflation over time, just not too much of it. And now we're in the back in the zone where we're having inflation, but it's not 10%. So to me, that just seems like a weird, I guess, like, argument, because again, like, you go back any time in US history, the dollar was technically like less or worth less than it was 20 years prior, and that's just how it's been. And so I think, you know, I guess some people think that eventually the dollar is going to zero and going to be worthless, and that's why you should buy gold or buy Bitcoin. I just don't think that's necessarily true. But again, that's just, you know, my opinion. I think a lot of economists.
And again, I'm not a currency trader here either. I own US dollars. You know, I own some Bitcoin there too, called a little bit of a hedge. But this argument about, you know, the dollar going to zero has been out there, to your point, for ever since I started professionally in the markets in 1999. And that's what I heard about was, you know, the dollar, the debt, you know, going up. And all it done as it continued is go exponential, the debt. Yet the dollar is still, US dollar, still relatively strong compared to the rest of the world. Still holding up relatively strong. Are we all going to go and trade in yuan? I mean, you know, are we going to go to Bitcoin? it's just the currency that's used around the world still, and that takes a long time. Maybe eventually we transact in some crypto thing. Nobody has a crystal ball, but I still think US dollars, are still the place where a lot of people still want to be.
All right, we've got about 1 minute left. This won't be the end of the show. We do have little.
Yep.
Oh, I can bring Zunaid on now. Yeah, let's
bring Zunaid in.
What is going on? Good morning.
Zed. I was calling Zed. What's going on?
Love when you call me that, man. I'm doing well. I'm excited. The weather's finally nice a little bit. I got my hot girl walk on this morning, so I'm excited for the markets, man. It should be fun.
You've got your Falcons playing tonight too, huh?
Oh yeah, they are playing tonight. I try not to be disappointed.
You don't even care. You don't care. You don't. Maybe you are. Maybe you are Canadian, Zunaid, because you don't even care about your NFL football team.
I know.
Oh my God! Is it because there's just other things in Atlanta? In Detroit, it's all football. Like you couldn't be here and not care about the Lions, but you don't. You're not worried about what Kirk Cousins and the Atlanta Falcons do tonight.
Yeah, there's two things I'm not over: my ex and 28-3 in the Super Bowl. So still dealing with it.
All right, Zunaid, I'll let you hold it over. I know we've got an exciting interview coming up here. A little bonus action, little bonus content on pre-market prep this morning. So smash the like, subscribe to the channel if you haven't already, because we're not only giving you an hour of pre-market content today. We're going extra. We're going overtime. And Zunaid, I'll let you introduce that, and we'll turn it over to you.
You got it, Dennis. Good morning. Good luck to you. AB, I'll see you later, my man. And look, I may not be Canadian, but I do have a friend of mine who is Canadian. I want to go and bring on my man, Sanket Patel, who is an investment representative at TradeZero. Sanket, good morning. How are you?
I'm good. How are you, Zunaid? Good morning.
I'm doing great. And I want to tell the folks the reason we're interviewing you here today is because we have our trading competition. And by the way, today's the first trading day. So if you haven't, we'll put the link in the chat. It's already pinned. Make sure you guys sign up. But TradeZero held an internal competition, I believe a couple of weeks ago, and you won that competition. So I wanted to talk to you about that, see what trading strategies you used, and see what insights you may have coming into the market. But before I do all that, give me an idea of what your trading background is.
So I have been actively trading stocks for the past 8 years and the options for the last 3 years. So my trading journey has given me insight into market behavior strategies that align with the long-term growth and the short-term opportunities. I have traded both the market, Canadian market and the US market, and also one more market, which is Indian market, which is less volatile than this market. So I have a lot of experience in different markets.
So with that, okay, so you have a lot of experience clearly, right? 8 years total, 3 years about options. So you know what you're doing on that side of things. We started off with 100,000, I assume, right? And if that's the case, then what did you end up with at the end of the competition?
So yes, I started with 100,000, and at the end of the competition, I achieved a total of $230,000, which represent 130,000 profit.
And then So you got about 130,000. Now we all know that paper trading can be a little more risky. You can kind of do a little bit more things just because you're not emotionally attached to it. But tell me what your biggest trade was.
So I try my best to put my trades below 20,000 total equities. So I don't spend more on my trades. So my biggest trade during the competition was purchasing around 20 contracts of SPX, and I sold the contract within 15 minutes and get profit of around $20,000.
Okay, gotcha. So you don't go all crazy because the competition does allow people, if they wanted to buy $50,000 worth of contracts, limits, whatever the case is, they can utilize that. But you try to limit it to at least $20,000 or less. We talked about the biggest gains. Tell me your biggest loss.
So yes, I did experience a notable loss during a short trade, which is I shorted around 5,000 shares in the stocks, and the stock jumped to $2, which results around $10,000 in loss. You know, the short trade is risky, but you get more money in it as well.
With you trading for 8 years, right? And then of course people are, signing up for the competition. I see folks asking in the chat about things like that. Any strategies, whether it's in the trading competition or whether it's your real money fund that you've been trading for the past 8 years, give us a strategy that you utilize today to kind of get some profits your way.
So most of my trades focus on options. Right now, before I was trading stocks, but I frequently trade near the VWAP. So I wait for the stock to drop near the VWAP and then buy puts, which has been a key strategy in achieving around 70% of my profits.
So hold on. So the stock. So does you look for a stock that's relatively weak, and then it comes back to test VWAP, and then you go ahead and grab puts? Is that a
Yes.
generic idea of what I'm thinking?
Yes, so once the candle close below the VWAP, so most of the time like it will just drop below the VWAP because it's weak. So 70% of the like trades are in profit when you try that.
Yeah. All right. Any tickers that you're watching in the markets, whether it's this week, next month, doesn't matter. What's in the markets that you're utilizing for not just the trading competition, but also your actual real money fund account?
Yes, so this week I'm closely monitoring like SPY, Nvidia, Apple, Tesla. These stocks have shown like high volatility recently and presenting a potential opportunities that align with my strategies. So the anticipation of possible rate cut during the upcoming like FOMC meeting is creating the high volatility in the market, and this helps with my strategies.
All right. Any tips for folks that, sometimes may have losses in the markets? How do you bounce back? I love the human element of it.
Sorry, can you repeat?
Like, say you take a loss in the markets, right? How do you kind of bounce back and not emotionally go in like tilt mode? Like, how do you kind of prepare yourself to take the next trade and forget about what happened?
So what I do, like I try not to cover my losses because when you try to cover your losses, you will make more loss,
Yeah.
right? So what I do, I just wait for the opportunities. If I made loss today, I will not trade again if I don't see any opportunity.
Yeah.
So I try my best to do less trade and more profit.
All right. So you try not to go ahead and just be like, all right, I lost 200, 300 bucks. Let me get it back on this trade. You just keep continuing following your system. I've got one question in the chat, and then I'll go ahead and let you go here. What timing do you use on your charts? Are you using the 1 minute, 5 minute, 10 minute, 15? What are you rocking with?
So I use 5 minute chart.
Okay.
Yeah,
Got it.
because sometime like I was trying 3 minute chart, but sometime it is broken. Like you will not get the perfect result in the 3 minute chart.
Yeah.
So I use 5 minute chart only.
Yeah. Well, look, the smaller you go in terms of minutes, the more issues you have. You did mention VWAP. Last question here. Any other indicators you like to use outside of VWAP?
So other indication like I try RSI. So sometime use RSI because when it is weak, like it if it is oversold, right? So I
Yeah.
try my best if I'm taking my long position. So I
Yeah.
tried the RSI near 25, and I make my like long position.
Awesome. Sanket, appreciate you for coming out and hanging out with me and giving me your insights. Congrats again on winning the competition. I hope Dan gave you 100% raise for winning it. But best of luck out there, man. We appreciate everything that you do.
Thank you, Sunit.
You
Have a good day.
got it. Absolutely. That was Sanket Patel, who won the internal competition that Trade Zero held. And again, today is day number 1 of the trading competition that we are hosting. You have $30,000 that you can win, right? You can win up to $30,000 as an individual. You get 3 chances throughout the year to get a tour of the New York Stock Exchange. You get 3 chances to win a lifetime access to Benzinga Pro. We also have 1 year access to Benzinga Pro, and you also get lunch on us when you are at the New York Stock Exchange as well. It is 100% free. You do not have to risk a single penny, and you can win up to $30,000. I'm going to go ahead and send this over to live trading with Ryan and 13. I'm going to join him to talk about some trading competition. I'm going to place a few trades there as well. But thank you for watching Pre-Market Prep. Coming up next is live trading with Ryan and 13.